Thank you, guys. That's me. There I am. So this is what we're going to talk about. We're going to cover how you can give today to your family, how you can give today to charity in the most tax efficient way, how you can give through your estate most efficiently to your family or heirs, and how you can give efficiently through your estate to charity. And we will talk about ways, some nifty approaches where you can leverage your philanthropic intentions to sell assets and pay no taxes and set up increase the income that you receive so it addresses your needs first. And it's not just about charity and others, but how do you better take care of yourself. So that's what we're going to do. But first, as unfortunately for you, is my tradition, we have to start with a quick joke. And so it's one that I fear that Stephanie may have heard in past iterations. I've been in the fundraising. I'm a estate planning attorney who's not on license of the state of California. I'm not practicing, and I then worked with charities for the last 25 years, and am in that capacity now. The last 2 years, I am a consultant, and so I have the pleasure of teaming up with Lucky Duck Foundation and having lots of meetings and strategies with wonderful Allie and Alex. And so that's why I'm here. But the joke is as follows, and it's the only charitable joke I know. Be out and here with me, and your first challenge is to afterwards tap me on the shoulder and give me a better one. Happily, but it goes as such. There is a philanthropic pig. We saw a picture earlier, and a philanthropic cow, and they're talking to each other because little do we know, they actually have the special language that they can communicate. And so these two philanthropists are talking, and the pig is upset, very stressed, because the pig is complaining to the cow that she gets no respect. The pig is left outside at night in the whatever weather elements there are, grovels in the mud, dirty, never clean, isn't given a pet name, and then she refers to Betsy, the cow, who has a name, sleeps in the barn every night, is treated well, and the pig feels philanthropically that's not fair because the pig gives itself to humankind. It's pork chops, it's honey baked ham, it's bacon, sausage, it's all there to be given. And why is the pig still outside and gets such poor treatment? So Betsy thinks about it for a moment, shows off, swats a couple flies, chews a little grass, kind of pondering the question, and then Betsy turns to the pig, the nameless pig, and says, the reason why I'm treated so well is I give while I'm living. Takes a little way there, gets milk, cheese, all the ways, there you go. That's all I got. So, sorry. But that is part of our theme, is there's lots of benefits and additional benefits to give while you're living. And so with that, I'll behave myself and go to the corner. And so this is what we'll talk about in the second half, but this is to wet your whistle a little bit, that after we learn how to give efficiently, this will allow us to address some personal issues, such as needing more income for retirement, being able to sell a business or real estate without paying tax, to address the needs of your children. Giving does not have to be exclusive of taking care of your family, as well as transferring business and other assets to be inherited without having to, as you hear, selling the family farm just to pass on assets, and of course, and just how to leverage. And so that's for later. And for now, let's get rolling. How to give, and I'll breeze through the basics, but to get to some hopefully important points. There's lots of ways to give to your family or charity. You can you cut a check. And these days, younger you are, what is cutting a check? It's now my children don't even own checkbooks. They have accounts, but they don't even own checkbooks. So there's different ways to do it online, of course. Giving personal property to family or friends. Some organizations, nonprofits, accept cars. And what it takes isn't just here's the keys. As we all know, probably most of us transferred a vehicle you go to the DMV, and if you're selling privately or giving to a nonprofit, there's a bill of sale that confirms it, and that's how you get a potential protection. Stocks, you will contact your broker or for online to have access. Retirement plans, you actually don't give those during your lifetime. That's for an inheritance. We'll talk about later. In real estate, so there's lots of ways, nothing earth-shaking there. But here's our first thing where we roll up our sleeves. A lot of words, but I'll just give you the details. Is that the giving is here's some details. So when you receive something in your shoes of the receiver, the children, the heirs who receive a gift in any one of those forms, they don't pay any tax at that moment when they're now the owner of whatever we just talked about, stock, real estate, cash. They now own it, and there's nothing that happened to cause them to pay any income tax at all. And it can be a nifty, I'll give you a quick one example where it can be kind of nifty is if you have some stock, it's gone up in value, and you want to make a gift to your nephew. And you were planning on just transferring some money, but if you instead give your nephew, who may be younger, maybe not earning a lot of money at this point, some stock that's gone up in value. You bought some Qualcomm at $1 and it's now worth 10. And you then give your nephew the $10 in Qualcomm. That the nephew, maybe with the help of the parents, young nephew, can sell that stock and may pay no tax because nephew is not earning money and not in any tax bracket or the very low tax bracket because nephew doesn't have a full-time job yet. So that can be a nice way to make a gift to a family member. And if you would have sold the stock and then given the cash to your nephew, you would pay tax on the gain in that stock because it's gone up in value. You pay $1 for 10. When you sell the stock, you pay tax on the $9 in gain and going from 1 to 10. So, and also if you make gifts to family members, it's not at your estate. You will get to estate taxes later and where they get. But I'll also mention the number, which we'll cover in greater detail later, in that if you do give lots and lots to estates, the magic number when it's an issue for it's actually gift in estate tax is this number right here, 12.06 million. It's a pretty big number per spouse. So husband and wife could actually give up to $24 million away and not face any gift or estate tax. But that number was increased in 2017 and is set to sunset, as they talked in Congress terms, and in that it's not that in 2025, unless Congress does something different, it's not 12.06 anymore. It is 4.5 per spouse. So suddenly, numbers that think like that's never going to be an issue for me. You know, real estate in San Diego, then you may very well, and you have a couple other assets held or 2 real estate holdings, then you may be facing that number. And so that is what the number will be unless, which Congress passes a bill to change that. You know, that's not something to count on at all. And so that number suddenly will put into play a lot more households that will benefit by, will recognize that if they don't give away more, they'll be paying up to 40% of it to Uncle Sam, because that's the top rate for state and gift taxes. We'll cover that more. But in the meantime, a nice thing to do, if you're trying to lower your estate a little bit and knowing that every dollar above those thresholds are taxed, will be eventually taxed under inheritance tax, which is the other term for estate tax, is that every year you can give up to $15,000 away to children, family, friends, and then it won't even be viewed as a gift tax. It won't as a gift, so it won't even come under that, that kind of magical counting that you're doing. If you make some gifts during your life, but you have 12.06 to give away, and you give a million, wonderful. Then you have 11.06 left to give away or be inherited without tax. But if you do it in smaller increments and you give $15,000 to any individual, that's not counted against your number, whether it's 12.06 or maybe 4.5. So you can give up to $15,000 a year per spouse. So husband and wife can give to an heir 15 each, and 30 as much as 30,000 that year, and then it can be at 30,000 again the next year. Or if you have my quick example of 6 grandchildren, you can give 30 each times 6. Well, I guess it would be 8 grandchildren. That would make bad math by me. 8 grandchildren, and then you would get 240,000 given away out of your estate and on to your grandchildren. So fancy stuff, but it's 15,000 is a magic number to also be aware of what you can give each year. Now, so that's got implications for giving to heirs. And now here's some nice important concept to be aware of when you give to charity. If you write a $5,000 check to Feeding San Diego, magnificent, wonderful. As we know, it'll make a great impact. But most people, 95% of Americans, will not actually save any tax dollars with that $5,000 check. And the question is, do you itemize your taxes? Because if you don't itemize your taxes, then you'll be using this nice per person standard deduction of $12,950. And that's nice. That reduces your taxable income and there's less taxes to pay. But the fact that you give $5,000 to Feeding San Diego, that doesn't lower your taxes at all. If you use your standard deduction and don't itemize. If you itemize, because you also have deductions like mortgage and property tax and maybe some other charitable gifts, then yes, the $5,000 check gift does help you. So that's something to be aware of and ask yourself if you itemize or not. And we'll get to details that covers that more. I'll just mention if you're giving cars or art to charity, the deduction for a car is not as much as you'd like because it's not what you paid for the car. It's what it's worth at the time you actually give it to the nonprofit. And so it's a lower of what's called the fair market value or cost basis. And if you give art, and it might be something very valuable, but if it's art to Feeding San Diego, it'll be wonderful. Someone has a Picasso and they maybe paid many years ago, not that much money for it. Their deduction will be limited to what they actually paid for it and not the value of it, unless you give it to what's called a related use, which in most cases is an art museum. So art isn't always the best asset to use in your charitable giving. Now stocks, that's another thing that we'll cover with an example, but can be very powerful because just like we talked about in that Qualcomm stock that paid $1 and now it's worth 10, and that's a good gift to give to your nephew. It's also a fantastic gift to give to a nonprofit because you can give the $10 worth of stock, which is $10,000 worth of stock, to the nonprofit. The nonprofit sells it. Nonprofits don't pay any tax on income. So the nonprofit will benefit by $10,000 for that stock. But the good news is you will never have had to pay the gain on the fact that you only paid $1,000 for it. Because in contrast, if you would have sold the stock first and then transferred $10,000 in cash, you'd be subject to capital gains tax on the $9,000 in gain, the difference between the $1,000 you paid and the $10,000 you sold. And that can be avoided by just giving the stock to nonprofit. So that's another kind of tip of the day is give stock, not cash, if you're able to give.
Is that just individual stocks or mutual funds as well?
It can be funds if they're traded and valued as kind of an entity to itself as a share. Then the share has built-in gain and you can avoid that gain. Some funds are then, it's a whole portfolio and then real estate on a bigger level and where particularly you're advocating for a nonprofit, and I know, we have a lot of people who are representing nonprofits, that, a lot of donors aren't aware that they're considering making a pretty significant gift. And they aren't aware that they could give, and say it's $100,000, and they're about to transfer some cash for the $100,000. They could give $100,000 worth of real estate that has gone up in value, and that will be worth $100,000 to the nonprofit, and it'll be much better for that donor because they never had to pay tax on the difference in the growth of the real estate, just like stock. And you're thinking, well, I don't have, that's not a perfect number, 100,000, but you can turn to a nonprofit and say, what about, you have $1 million property, I mean, turn to a donor and say, and I know you're only intended to give 100,000, so how about 10% of your real estate? And then they deed 10% of the real estate, and 100,000 comes to the nonprofit. The donor is delighted because they avoided all the tax on the 90,000 that would have been resulted when they sell their real estate. They've avoided that, and they get a $100,000 deduction, and they will be itemizing because 100,000 is bigger than 12,000. So it's a double win. And oftentimes, a delighted donor says, "Ooh, with all those savings, maybe I'll give 150,000. Maybe I'll give 200. Or I'll give 20% of my real estate and get even greater benefits." So it's very powerful and easy to do. Just bigger numbers, same concept. And then just,
Well,
yes.
Sorry,
No, please.
I think on the previous
Yep.
slide, I interrupted you.
It's okay.
You skipped IRA.
Well, okay, but I have an example. Thank
Okay.
you. But I have an example, but thank you. We'll have to go on the road together. Because IRA is an important thing to mention here, and it will be mentioned again later, is that IRAs are another fantastic way to give. We talked about the issue if you give cash, you may or may not get a deduction if. It's an extra if you have to be 72 years old or older, and then you can, and you have an IRA. And that means if you're 72 and have an IRA, you are receiving a required minimum distribution. That the IRA say every year, it's a certain calculation, a certain percentage of the total value of the IRA, and you're getting that, like it or not. It's going to come to you. And when it comes to you, that increases your taxable income. You're going to pay tax on what you receive. And so, and you might be in a circumstance where you're not itemizing, and so like, okay, I can get the $5,000, and I can write a $5,000 check, but I'm still paying tax on that $5,000 I've just received. But if you tell your IRA administrator, just an email, a phone call, there's always a company who's holding your IRA, and you say, send that $5,000 that you are required to send to me, send it straight to Lucky Duck Foundation. And if you do that, then Lucky Duck will receive it, $5,000, and the $5,000 will be treated as never hitting you in your tax line at all. And so your taxable income will be $5,000 lower because you never received it directly as the required minimum distribution. And because your taxable income is $5,000 lower, in essence, you just took a $5,000 deduction because you lowered your income by $5,000. So that's a way, even if you don't itemize, and if you have an IRA, and the third if you happen to be 72 or older, you can reduce your taxes, even though you're not an itemizer, if you have an IRA. When you give cash, and we'll use an example, one of your donors has $500,000 in income, and they're $200,000 in income, and they want to make a gift of $150,000, and that's amazing and fantastic. But they actually, so you think, okay, if you give 150 away and you have 200 of income, are you just going to subtract those and then only have $50,000 in income that you'll pay tax on? 200 minus the 150 gift? And the answer is not quite, because there's a limit. It's a generous limit for cash gifts, and that is 60%. You can use, in that given year, you can use your deduction to offset up to 60% of your what's called adjusted gross income, your income line. And in my example of 200,000, 60% of 200, who's quick with numbers? Who can tell me what's 60% of 200,000? 120. So normally, I apologize. I usually bring some candy and give it.
He's fine.
Right answer is pretend I'm tossing you a delicious candy bar.
Just take the hat.
So that would be, so you would deduct 120,000. Even though you give 150 away, you get a $120,000 deduction that year, and then you have 30 left over, and you'll use that the next year. So it's used, but you have up to 6 years to use it up. But there is a limitation. and it's a little more real. And then, and it saves you. No, it's a deduction, not a credit, but it'll save you in essence if you're in the top tax bracket of 37%. For every dollar you give away, it'll save you 37 cents because that's how much you pull tax under your income. That's your bracket. The limit's a little lower for stock and tangible personal property and real estate, anything that has what's called a capital gain because it's gone up in value. So in our example, $200,000, and someone gives $100,000 away in stock or a real estate share, I'll spare you the math that I know you can do it. 30% of 200 is 60. So in that year, you can only deduct $60,000 from your income. And if you give 100, you'll have 40 left over unused, and then you'll use it the next year. So that's the limitations connected to adjusted gross income. These are good initials just to like impress friends and family and cocktail parties and whatnot. I just made a gift and start throwing out, and it's reducing my AGI by 30%. And I might be using my RMD this year in the IRA rollover. By then, people are all crowded around you, offering you drinks and food, and you're like a party. It works like that every time. So,
I just have a quick.
yes, please.
I'm sorry that
No.
I'm trying to wrap my
Yeah.
head around the gifting to our children
Yes.
along the way.
Mhm.
How was that? You did have tax deduction. I make $200,000 a year. I gift my children a one-time $30,000 platinum and white. 30,000.
Yeah.
Where's that?
Yeah, so that it doesn't save on your income taxes,
Okay.
but it will not count against your
Estate.
estate tax credit. So the total amount, then you're able, whether it's 12 million or 4.5, if you give your children in a given year more than 30,000, the amount over the 30 will chip away and lower that number. It's kind of like keeping a running tally. Over your course of your lifetime, so you give $2 million away to anyone, any heirs, collectively, in aggregate. Then you subtract that, then you only have 10 million more to give after your lifetime. Or if it's down to 4.5, then you give 2 away during your lifetime. Now you only have 2.5 left to give through your estate to heirs without paying estate tax. So it helps in the long term in that tally, but the gifts to the children don't help now unless they have very low bracket. You give them a little stock and then they sell to Qualcomm.
Because that's their income at that point.
That's their income and not
And they now
yours.
have to input it in their taxes.
Right, but if their taxes are so low that they're not paying any tax or it's the smallest of brackets, then that was a good thing, crap.
So we should use that before they're out of point. The idea would be to use it before they're out of point where it's going to end.
Yeah, a true story. It's my only one that's slightly, well, yes, I will brag, kid, with different things. But nothing smart financial news. I gave my goddaughter, 1998, a few shares of Qualcomm, and it literally was $200 worth, and it's now worth like $20,000. I didn't find it for myself. I didn't still benefit, but she got some. And then I tracked that and reminded her, and when she was at age 18, I said, time to sell some of that, and you can buy right back. But start selling that periodically before you have a job. That's going to cause your income to go up, and so she did. So she's better off. So here's our two. Now we're just kind of going a little deeper into our two of our 3 takeaways for our initial session, and it's what we've just been talking about. It's the gift of why giving stock is a good idea. And we just go through an example one more time. And this is gifts to charity. And so in the case here, if you give the stock and it's gone up in value, that's appreciated assets. It seems different terms and you're never quite sure what you're referencing. But it's appreciated assets, or maybe it'll be referred to as long-term capital gains that's unpaid yet. And so then you can have this example where mom paid $10,000 for stock, it's now worth $100,000, and then why not have mom pay, and she wants to make a gift of $100,000, give the stock. Don't give, you're right, no, don't give, don't transfer $100,000 in cash. And then you will never have had to pay tax on the increase in value from the 10 to the 190. And it's with the limitation that, as we just discussed, that you can only in 1 year deduct no more than lower your taxable income by 30%. But then whatever's left over is left over. And then I already used that example on the real estate, but just to see it again slower in words, if you're have property and it paid 100 and it's worth $1 million, or it's a portion of it. It might be the property's worth a higher percentage, but you want to give that portion away to charity. In this case, she wants to give 10% away and wants to just give $100,000 instead of giving cash, give a 10% interest in the property. And yes, there's some details to it. If you give a 10% fee to Peak in San Diego, they will likely take it. They will ask a few questions first and make sure that there's not hidden obligations, a mortgage, where there's that it's a toxic waste dump that could have potential liability. So it's not an automatic and the deed over same day and you're on the way, but it could be very advantageous. So that's could you have to stock. And the other one that we want to take away to remember is the IRA example. Keeping my IRA example together, and that again, just to see a little slower, that for 72, and that means you have an IRA, you are receiving a required minimum distribution every year that you're going to get money. And then why not have, if you direct the money to go straight to charity, you will not have to pay tax. So here's our example, $5,000 gift. If mom doesn't itemize, she doesn't save. But if she gives, not even all, it doesn't have to be your entire required minimum distribution. In our example, she gets 8 a year. She's going to give 5 of it straight to Lucky Duck, and then she will only pay tax on the $3,000 that she does get, and then instead of paying tax on $8,000, she's only paying tax on $3,000, which is the equivalent of deducting $5,000 because she never had to pay tax on it. There's some, again, to really impress your friends, they dim into drinks and food at the party, and then, and they'll ask and try to trick you and say, well, I'm only 70. Can I start dimming? And the answer is yes. You're not required to take a minimum distribution, but you can start at age 70, start giving from your IRA to nonprofits, and you will have the same benefit. You will not get taxed at all and have a huge benefit to charity. And for some reason, they have a $100,000 maximum of that. I don't know why Congress said no more than $100,000 in a given year. But so that's our IRA example. 2 things. Yes, please.
Can we take the money and then gift it, or do they have to instruct the institution to spend it in like the 10 actually?
Correct. Now, theoretically, if it cannot be in the end, it has to go straight from the institution. Now, theoretically, they can send a check to you made out to the nonprofit, and it's not in your hands because it's not made out to you. But it has to, that's the whole thing they're trying to, they have to draw the line. The bill reaches you, made out to you, too late. It's already been received. So,
This is IRA only, not 401. Okay.
Correct. Good. Another great question, Keith, is what oftentimes people can do, though, is when you have a 401k or all the other variations of retirement plans, you usually can convert them to become IRAs without paying any tax. And then you can do it. But again, for some reason beyond me, they have only provided this opportunity for IRAs. So it would take another step to the retirement plan and not an IRA to check with your administrator if you can convert it. Yes.
And is it $100,000 per person or for IRA?
This one weirdly is per IRA.
Per IRA.
But sometimes you might have 2 different accounts,
Yeah.
and then each IRA can do it.
Okay.
But per IRA account is the weird rules. So now we haven't covered yet, and a lot of people want to talk about it, and we will. So the last thing is, what is a charity? They have these benefits. What is nonprofit? The magic code in the Internal Revenue Code is 501c3. I've heard that reference before. And what it means is that a lot of what looks like a duck, quacks like a duck is a duck. If it's for good public good, it probably is a public charity, but you'd want to know and see if it's a small organization that they have deemed qualification. And they're usually in any of the sectors like health, education, religious, public service, community, bad spelling. And private foundations work too, and family foundations. They have slightly lower limitations on the amounts, but those work. And there's basic things called supporting awards and a much more common vehicle called donor advised funds that smartly a lot of organizations like Vanguard and Fidelity have jumped into that arena very strongly and handle billions and billions of dollars, I think trillions. And you may same rules apply because they're technically called a separate account and donor advised fund. And it's treated like a charity, even though it's Fidelity holding your charitable dollars in a donor advised fund. So now I want to cover another important thing. So we talked about these are lifetime giving, and now how do we transfer assets to family and nonprofits after a lifetime? And so quickly, the big things you'll see tucked in the bullet points: wills and living trusts. But know that if you didn't do anything, never got around to it, there's a plan, and the plan is directed towards basically in California. It's a community property state. That's a magic word. And so it's viewed initially that each spouse is viewed as holding 50% each. And when one passes away, the assets automatically go to the other. So even if you don't have a will, if you have community property, there will be an inheritance. It will pass on from spouse to spouse, but with a lot of hassle because you will likely have to go through probate, which is expensive, time-consuming, and intrusive, which we'll get to. So that's what happens when you do nothing. Then people say, okay, I'm going to get back to you, and I will have a will, because the will is the only way that if you want to give to a nonprofit, they're not going to intuit that you were charitable to a couple nonprofits during your lifetime, but you never set up a will. The government, they're not going to allow you any of those funds to go to that nonprofit. They're going, according to state law, to heirs. Sometimes a 12th cousin might be the heir, only living heir. They'll get the funds, but not a nonprofit. But if you have a will, you can say what you want. And you can have it go to children with directions and all the things that we're probably pretty familiar with. But know that a will by itself is great. Yes, please.
That's all right. I was just wanting to back up to the first one. What's the SP?
Oh,
What's that
thank you.
15th?
You guys are keeping me honest. Separate property. So if you do have in community property, you might have inherited something, and you kept it separate. Bob gave it to me, and and for whatever reason, you just kept the name of it under my name, and then that's considered separate property. And so that property doesn't all go to the surviving spouse, and that particularly comes the more relevant second marriages, third marriages, where you can you bring the assets on that you really do want to go to your children from the first marriage, that type of thing. And so that can be held in separate property. But if you don't have directions, even under separate property, 50% of that will go to the spouse and the other 50% goes to children. That's the law. If you don't have a will stating differently. There's different rules for separate property. Thank you. And then if you have a will, we can clarify it. But so now you think, okay, I set up a will. Well, not so fast, because you will still, even if you do it right, and there's still some requirements to do it right, have witnesses. You can't just write it out yourself. But if you do it right, you will still go through probate. And there's this whole system which has good purposes, to make sure that your instructions are followed. And so you're in a case where there's some concern, there's different competing parties who might have an interest in inheriting. Probate is helpful because it makes sure that everyone has to report the plan to court, and the judge approves it, sees what the plan is, the distribution plan, and looks at the will, makes sure that's being followed, and that's good. And the attorney is part of it, and the executor is the person, a trusted person appointed by the deceased who oversees this, and that's helpful. But if you know what you're doing and there's really no one going to contest things, and you want these assets to pass on to these two children, or you want them to go to these two children and this nonprofit, everyone knows what the plan is. Why are you going through what's likely at least a year's delay to have the distribution take place and a cost? It's usually about 2% of the estate that's probated will go in attorney's fees and executive fees and court fees. And that's just a waste of money. And technically, it's also open to the public. Anyone can go to the court or access court filings and read a will. When I was in law school, they would be interesting because there was some interesting celebrities who had wills that were probated, and you could see what I remember. It was Dracula, Bela Lugosi. You know, you can see what he had some in Hollywood and the Bay Area, and so he had some quirky, distributions, and it was there for public to see. So if you don't necessarily want that and the other reasons, maybe go one step further and have a living trust. Sometimes it's called a family trust. And that will then basically say the same thing as the will. You'll say where you want the funds to go, but because you trust the distribution, you trust that this will go to my 2 children and my 2 favorite nonprofits. If I trust this person as the trustee, it's a child, it's a longtime friend who will serve as trustee, why go through the headache of the cost and the delay of probate? That day, 30 days after or 60 days after someone dies, you already have a death certificate. You can then go to all the accounts and need to show your trust document and your death certificate and say, okay, I'm now transferring, and you make your transfers when you're done. And so you save time, expense, privacy, and you have a living trust. But one fallacy is that, going a little bit ahead, but is that some people have a living trust and I'm good. I've got all my claims taken care of. And they've avoided probate, but they haven't addressed if they are facing estate taxes. And so that is not necessarily handled entirely just because you have a living trust. We'll get to that. There's a couple other ways, beware, in a good way, that you can not have a will and still transfer some assets without probate and cost and delays. One is retirement accounts, the bullet point below living trust. Those, you have a beneficiary, and that will automatically go to your heirs, and you won't have to have any delays. You just submit to whoever's holding the retirement account, JP Morgan, and say, here's, this person's passed away, and then they'll know to make the beneficiaries to do will be now that they'll now own those various retirement accounts. And then you can do things on property where you can have a joint tenancy or other ways that you can, it already says in the deed, it says due on death, DOD, or payable on death, POD, for a bank account, that it already gives the directions of who's to receive these assets after you pass away. And so that avoids probate. That's only with a specific isolated asset. So there are things that you can do, and if it's a particularly small account, for estate tax purpose or probate purposes, less than $150,000, it's an easier process to also transfer funds. So those are that's a little bit of the ABCs on documents to transfer assets. Other questions? We're not leaving it entirely, but don't hesitate. So I'll mention that these are usually the complementary documents that you'll see circulating around when you have a will. In particular, you might have a power of attorney and these are living benefits. If you're traveling around the world and you're tied up in another part of the country or you're sick, COVID, we all, I think, greater appreciate durable powers of attorney because you want to have someone be able to sign document, pay bills, and make financial decisions, pay rent, and do other things just to continue on with the needs of that individual while they're, in the ICU and not able to do this directly. Sometimes you can specify specific powers just for financial transactions, others for healthcare decisions. It is a separate document for end-of-life directives. And these are things that can be, and then you can also specify guardianship, you have young children, who's to take care of the kids, conservatorship, if I'm ever incapacitated, who should look after me. And these things can be rolled into that living trust. So it's a little cleaner also, if you do have a living trust, not just a will. Not only do you avoid probate, but you have a clean document that has all these kind of provisions all in one. No income tax when you inherit any assets, stock, real estate, cash, whatever it may be. And the estate will only pay if they're over these minimums that we talked about earlier, the 12.06, that will come down to 4.5. The estate, before it gives the assets away to the heirs and nonprofits, will only pay with the amount owed to this. And of course, an important plug right here for nonprofits is if your estate is 13.06 and not 12.06, and you have in your will or living trust that $1 million is going to split between Wateduck and Phoenix San Diego, then the government will view it as you only have 12.06 going to heirs, living heirs, and you will not be subject to any estate tax. So it's particularly powerful because if the heirs receive that extra million, they're going to be subject to 40% tax. And if Phoenix San Diego and Wateduck receives it, no tax. So in essence, it only costs you 60 cents on the dollar to give to nonprofits. And it's even cheaper if you give it during your lifetime, because then you also get some income tax savings and whatnot. It might only cost you 20 or 30 cents on the dollar to help a nonprofit receive a full dollar. So that's using the estate tax to your benefit. And so now, this is our other magical term that we want to never forget. So, maybe even try it. Yes, it's catching. Stepped up basis. It's not that bad. Stepped up basis, Abrams. It doesn't fall over. It's not too bad. What happens is if you inherit, and from the eyes of the recipient, we'll go to this example. Mom had paid $10,000 for stock. It's worth $100,000, and we'll go to, the two examples, and then mom passes away, and then the daughter receives the stock worth $100,000, and then it goes up $1,000 worth, and she sells it a few months later. The daughter, even though mom only paid 10, the daughter is going to be treated as if she paid the value at the time mom passed away. And at the time mom passed away, it was worth $100,000. So the daughter receives a stepped-up basis, where the basis, meaning cost, treated in the eyes of the IRS, how much did you pay for this? And how much, in the eyes of the IRS, they view the daughter as if she paid $100,000 for it. Even mom paid 10. And so the daughter sells it for $101. She pays just very little tax, just on the $1,000, and she receives $101. Now, in contrast, if the daughter would receive an IRA from their estate, we'll talk about it more, but then the daughter receives the IRA. Every time the daughter takes a distribution of any amount, it's just taxed. So not nearly as helpful to receive an IRA as it is to receive for the child, the heirs, as to receive appreciated assets, stock or real estate. So stepped up basis, when you decided what to give to your children, identify assets that would receive a stepped up basis, and then you know that they will receive much greater benefits for the asset, because there, the second bullet point, so that the inheritor is treated as if they purchased the asset on the day of death. So our example, as if they paid $100,000 for it, even though it was only 10, and then the heir will be taxed on the increase. Sadly, if mom would have sold that stock a couple weeks before passing, then mom's estate would owe tax on the $90,000 of increase. And while the daughter would receive $100,000, but the estate would have far less in it, because the estate would be paid income tax on the $92,000 of capital gains. So it is. So it's good planning as you're thinking about what to leave to your children, what to leave to nonprofits. First, look at IRAs and retirement plans to the nonprofits, and go beyond that, other assets. But the assets to give to children usually best are appreciated assets like stock and real estate.
Where does this annuity fall in?
Annuity is treated, anytime you receive annuity, it's treated as ordinary income, and unfortunately does not get a stepped up basis. If you inherit an annuity, just like you inherit an IRA, a retirement plan, you will be taxed every time you receive a payment from it. non-escrow. So this is our, and just the corollary of this is that best assets to give to your heirs through your estate are appreciated assets. And give capital gains to your heirs, and they get that stepped-up basis. SUB, that's that. If you're remaining your child stepped-up basis, sub. And retirement assets are great to do it to nonprofits. And in California, there's no separate state inheritance tax, but other states there are. And I happen to live in a state that is the worst. It is Oregon has an estate tax at the $1 million level. So if you have, an example, your mother lives in Oregon and owns real estate worth more than $1 million, there will be some the inheritance tax, state estate tax owed, even though that number is well below 4.5 billion, well below 12.06 billion, it still will be subject to state inheritance tax, which is as a lower bracket, it's about 20%. So if you inherit a $2 million property with a $1 million deduction, $1 million will be subject to state inheritance tax of 20%, $200,000 check out the door going to the state of Oregon. So it is real. There's very good questions, all of them. What else do we talk about? One was on the stepped-up basis if there's two people owning, either a brother and sister own property, and even though the DOD, that would avoid probate because the other sibling would inherit upon death, and then you sell the property. On half of it you would get a stepped-up basis on the half you inherited, but the half you still hold will be subject to a tax. And the other thing I hadn't mentioned is that if this property that's appreciated is your home, we do have an initial benefit for personal residence. And that's your personal residence, not one of many, but the one that you use your primary residence. Then you can exempt up to $250,000 of gain without paying any tax on sell that residence. So you have that extra cushion that's in there. Okay, now we have more. This is the part where you go from cocktail party favorite to hero, to all, to yourself, your family, and to your nonprofits. Because if you have intentions to help your philanthropic and maybe are giving, plan to give through your estate, there are opportunities to leverage that intention to great benefits. So here we go. The concept is that normally charitable gifts from your estate will mean they'll be less subject to estate taxes, but you do, as the second bullet point says, you do not save any income taxes, for during your lifetime because you have left a nonprofit in your will. It's wonderful. It's amazing. We celebrate that foresight. But you're not actually saving income taxes, and there are many cases you could. Not always, but you could. And there's one particular structure that the IRS has sanctioned, and they did this in 1969, and it's as embedded as can be. And that is when you irrevocably commit an asset after your lifetime to go to nonprofits. And we'll show you the various vehicles where if you irrevocably commit an asset after your lifetime to go to nonprofits, that you could receive some lifetime benefits for you, for your children, for all involved. So that's our concept. So our first example is this one. Someone would like to give more. They care very much about feeding San Diego and Lucky Duck, but they're just not sure. What if I live to be 110? Am I going to outlive my assets? Do I really have enough for retirement? Who knows? What is enough? And so there's one situation where if you happen to have, again, let's say you're holding some assets in your, in the bank, and they're getting very low interest. Now, you can get a little higher interest, but still it's modest. And then you're this is particularly helpful for someone older, let's say you're 80 years old, and you're getting a 4% CD, and you're not ready to just give $100,000 to Feeding San Diego, but you really, that's the plan. There's $100,000 going to Feeding San Diego, your state. Meanwhile, you're suffering by through up and down interest rates. Now it's 4%. A couple years ago it was 0% you could get from CDs. And so, is there a way that you could benefit more during your lifetime for your retirement? And we'll start with that one, and we'll go back to this charitable remainder trust later. But we're going to talk about this concept called the charitable gift annuity, which a nonprofit itself doesn't even need to offer it. Some larger universities and many hospitals, they have a whole gift annuity program where they'll issue gift annuities. But Feeding San Diego and Lucky Duck can affiliate with other organizations that pull these funds. The concept is this. They take that $100,000 and they hand it over to Feeding San Diego in return for a contract that gives them guaranteed lifetime interest payments. And it might be higher than that 6%. If you're 80 years old, it's probably 7%, and it's guaranteed at that rate. So if interest rates go down, back down to 4% or 2%, you're going to get 7% as long as you live, even if you live to 107. And so that's can be a nice option for someone who otherwise was, quote unquote, only giving through their estate plan. But because they set up this charitable gift annuity and got this one-page clean document back from Feeding San Diego that would be, it would be coordinated with this national organization that holds the funds, then you could get 7% back, and and most of it actually is tax-free, and it's enough of benefits. You actually get a tax deduction up front because you have given away the inheritance of that $100,000. It won't be the $100,000 deduction because you didn't just give it away, you did something to return income, but it might be $30,000 or $40,000. So you have benefits just coming all over the place because you are willing to take this money and lock it into just receiving these annuity payments. Now, annuity payment means you can't touch the principal, so you don't want to do it with every asset you have. But if you have you have some assets in real estate, you have some other stocks and other things that if you need to sell something, you can. Then why not take the money that's now sitting in low interest, bank accounts and use that to help you address your need. Same to the charity, they're getting the $100,000, but you're now getting potentially higher income and guaranteed and a tax deduction to boot. And so here's the specifics. I guess the rates change when you lock them in, but right now an 80-year-old, I misspoke. It's 6.5%. There's a national table, so it's not Lucky Duck, just shooting from the hip and say, oh, we'll give you such and such percentage. There's a national council called the American Council of Gift Annuitants that sets these rates and sets up in a way that makes sure that you can provide for donors, but have something left over for nonprofit. That's why the tax benefits are out there. So they, a big round number, they have $1 million in cash, but they're not necessarily thinking of giving it all away, but half of that they are planning to give to nonprofit in their life, anyway, after their lifetime. They can put that into the gift annuity, and instead of getting whatever CDs we're paying in money markets, it's a little higher than 1.5, but whatever it's paying today, instead they get 6.5% for life, and most of that, 3/4 of it, will be tax-free. So it's even a better benefit than 6.5%, and they get a tax deduction of $277, just a little over half of what they put in would be a tax deduction. So there's just two benefits you would not have otherwise. Yes.
Is the 6.5% usually a fixed rate, or does it fluctuate?
These gift annuities, annuity is the magic word, fixed. Now there's another option if you'd rather have variable rates because you want, as principal grows, you want to get higher payments in later years. But this is a fixed rate option, which there are people who say, I just want to go to town on this amount for the rest of my life, as long as I live. And the nice thing is that the charities know that after their lifetime, they will receive $100,000 or $500, whatever's put in there, and it allows the nonprofits to budget and to know that there's going to be future funds coming to them, and they can celebrate, that donor who makes that kind of gift and honor them also. So it's just important for the nonprofits, even though they're not touching any of the funds now. It's a great way of a win-win, helping better address the needs of a donor, and at the same time making a huge impact on the nonprofit. So charitable gift annuity for kind of lifetime income. And here's this American Council of Gift Annuity rates. So you can see, if you're 80 years old, it's 6.5%. If you're talking someone who's 90 years old, they can get 8.6%. If they're talking to someone younger, they can still do it, but it's locking in a lower rate. And the rates are lower if you're paying on the annuity for two annuitants, husband and wife. When rates are a little lower. So that's can be and just a good conversation to have. And that's the other goal of all of these and for nonprofit people is to offer some ideas that help the donors share what their goals are. And it might be not that they end up doing a charitable gift annuity, but you have a better understanding of what they're concerned about. They're concerned about having enough money, outliving their income, or they're concerned about, as we'll talk about, children and other concerns. Now you have some dialogue you could have that'll help you be a better advisor for them. And that's really the goal. It's not to have one particular magical tool be used by all. It's just to have a conversation. So here's our next example. Leveraging the fact that people, again, they put you in their estate. So I'm going to be selling my business, or let's say real estate. And I am, one day I've got $1 million in my estate that's coming to split between Feeding San Diego and Lucky Duck. So isn't that wonderful? But the reality is, if they sell that real estate for $1 million, and I'm not saying here, but they paid much less than that. I mean, they paid, as our other examples, $200,000. When they sell that, they're going to pay a big capital gains tax, and then they'll have less money to give to charity, less money for themselves, and it doesn't have to be that way. If they're planning anyway to give a significant amount to go to nonprofits, why not take one simple step? And that is, before you sell it, you take your deed. Charity pulls out your deed and changes the terms of the deed and deeds that property into the Abrams Charitable Remainder Trust. And now, in the terms of that trust, the new document, it's a new entity in the document, and all the document says it's mine, it's Hal's and his spouse to use for their lifetime, and after my lifetime, this is going irrevocably, can't change my mind, but it could be to Lucky Duck and Feeding San Diego, but actually they can still amend the percentages that go to different, they're committed to going to nonprofit, but they can actually retain the right to alter how much to various charities. But because they've committed to going to charity, now you can sell that property and pay no tax. You sell a $1 million property, yes, you'll have escrow fees and all the standard stuff that comes in, but no income tax owed at all. And otherwise, in our example, $800,000 tax, 20%, 30% effective rate between state and federal, might be like $250,000 out the door. But now isn't. Now it's there, still in that trust. So what a powerful benefit to, as you're talking, fundraisers, talking to donors, to inquire if they might be planning on selling some real estate, and that they put you in their estate. What a nice value to added to offer to be in that conversation to say, before you sell this, you might want to consider a charitable remainder trust. And the donors will have to know that before you sell assets, if you have some thoughts of a charitable gift to a nonprofit, wait a minute, and you might be able to marry the two concepts together and ultimately sell the property without tax. Now there's a big, you think about it, so the government's providing this huge benefit, and this is how it goes a little further. We have a couple that are 70. They've got $1 million in their estate. Just my example, where they paid $200, they were going to pay $800. Tax of $800,000. It's a lot of tax. And they're currently getting modest rents, because if the rental property, the rents are usually pretty low. The property has gone up quite a bit appreciation over the years. Rents have gone up some, but not at the same level. So effectively, they might be getting netting $30,000 from this rental. Well, they could set up a trust, put in their trust, have the property be sold, no more headache. That's done. Dealing with plumbing issue or electrical or anything that the tenants aren't happy, all gone, and they sell the property, and then the trust does. It's not going to just say take all these proceeds, $1 million, and spend it, because there's no benefit to charity. So what the IRS requires is that your benefit, once it's sold tax-free, is that you get an annuity payment for life, again, like the other, and this one can be variable. So you decide what's the amount you want, and this one I used an example of 6%. The people might be 55 years old, but they could still get 6%, and then they'll avoid the taxes. They will get 6% of $1 million, that's $60,000. They also get a big tax deduction. Again, it's benefits, it's coming right and left, walking you over here, then above. And so they will, and this is just what they need, because now they're going to get this kind of income, and if this trust grows, because you have $1 million and it earns more than 8%, and after a few years there's $1.5 million in there, well, guess what? You're going to get 6% of $1.5 million, and then that's $90,000. So you'll get increase in payments that could help with inflation and future needs. And again, you should have some other money aside if you need something to buy a new house, because this money is tied up. But this money to address, income for you for life can be very powerful, and a great way to sell an asset and pay no tax and leverage the fact that you want charity to receive this anyway. And when the dust clears in this example, if you put the $1 million in and it actually grew by 8%, then there would be not only would you start getting $90,000 in later years, but then there's $1.5 million that comes to the nonprofit after your lifetime. So they benefit more, you benefit more, Uncle Sam benefits less. And the concept is, all these, you have, in essence, just taken Uncle Sam's cut and moved it to where you want it to go, to a nonprofit or two that you care about, until it's a powerful vehicle. So now, similar concept, but why not the children? The children say, you come home and you let them know, I just talked to this guy, Hal, and I think I got a new plan. We're going to be selling that real estate. We sell all this tax, avoid all this tax. And the kids are nodding and they're kind of happy for you. And then you mention how after their lifetime, your lifetime, it goes to the nonprofit, and they're kind of thinking, wait a minute. And so, so of course it begs more important questions like, what, you're getting other assets. How much is too much? Should the children feel entitled to inherit everything from my estate? So some of those important philosophical questions to discuss. But even if it's viewed that you want to help them with this asset, there's ideas. And you can, so for instance, one is that you can take the additional liquidity you're getting and you can buy life insurance. Because you're now getting, in our example, $60,000 up to $90,000 a year, and maybe before you're getting $30,000. Well, that difference, maybe that's the amount you can buy for life insurance, and maybe if you buy it for up to $1 million worth, and then the kids will get the $1 million of life insurance. Now, if the donors are older, life insurance gets really spendy, and you may not do that. You might just take some of the extra income you're getting, and every year you park up to, as we learned, $30,000 for husband and wife into a separate account. That could be for the kids. And after a bunch of years, that is their, they get their share in plenty. So the kids don't have to be forgotten. And then there's even techniques where instead of having this be for you, for your lifetime, when you set up a trust, you can actually set up so the payments go to the kids. Or after a few years, stops going to me in, say, 5 years. My kids are 13, and I want them to get some extra money when they're in their college age years. So after 5 years, then they'll become the beneficiary, and they'll get the payment. And the only limitation is you can't do this forever, because the kids might need, if they're 13 years old, the IRS is not going to let this trust go on for a projected 70 or 80 years. But so they either do it based on people in the age usually 55 or 60 or older, or for younger recipients, beneficiaries, they have a 20-year max. Here, and then here's, this is an interesting concept to mention. It's something, again, very important in the cocktail circuit to know this, that a way to, when you're facing some estate tax, there's no hiding it. And one that got a lot of fame many years ago, state of Lee, Jackie Onassis. Jackie Onassis married after, John F. Kennedy. She married Aristotle Onassis, the Greek tycoon, and accumulated even more wealth. And so she had this very large estate. She wanted it to go to John Jr. and Caroline and probably grandchildren. And so, but it did, and had some smart tax planners identified ways to have those assets go without a huge cut being given to Uncle Sam. And the tax rate at the time for estate taxes was even higher than 40%. It was more like 60%. So they thought, you know what, we'd rather it to go to charity and not have this happen. So what you can do is you can front load, and Jackie Onassis was giving a significant amount each year to nonprofit causes. So you front load your giving, and you're giving each year, and you roll it into a trust. It's all about rolling into trust. So our example, and I think we have, yes, example here, at a smaller level than Jackie O, but there's a couple, and they're already giving $50,000 a year to charity. That's what they're doing. They plan to do indefinitely. But they have $1 million, property holding, and they would love it if they could pass that on to their children or grandchildren without the big estate tax hit. And they're over the 12.6 or over 4.5 million, and they're facing estate tax. So they put the apartment into a charitable lead trust in this case, and the apartment generates rent. And so every year the apartment generates at least $50,000 of rent. And so the terms of the trust are pay 5% for the next 20 years or it could be 15, but for many, many years, straight to nonprofits. So the nonprofits are getting the same $50,000 they were getting before, because the trust is holding this charitable lead trust, and the lead means leading with the charitable giving. So the lead trust is holding the $1 million, using the rent to pay $50,000 a year charity, and then and what happens is at the time this gift is made, because the children are going to get this property after 15 or 20 years. After the 15 or 20 years, the terms of the trust say now it goes to the children. But Uncle Sam does not look at this like $1 million transfer, because they're like, oh no, you're paying out 5% a year, and they have these ridiculously low assumptions that this trust, they have to make an assumption for all, is only earning 3 or 4%. So they assume this trust is almost going to be depleted, and they made present value calculations. So they're going to say, this is only a gift to your children of $300,000, even though the children are going to inherit this apartment after 15 or 20 years. And guess what? That property is going to be worth a lot more than 300. It's going to be worth a lot more than $1 million. Use your own imagination. What in San Diego, if you had 15 years ago a property and it was maintained, how much has that multiplied by? So when it's $2.5 million or 3.5 or whatnot, that entire asset will go to the children or grandchildren, and it'll only be viewed as if it was a gift of $300,000 off that ledger of the amount you have, $4.5 or $12 million to chip away at. So it only cost you, in your ledger is $300,000, and you got property that likely when you pass might be worth $2.5, $3, $4 million out of your estate. And it's consistent with what your plans are to be charitable, and it now locks in the giving. And so Lucky Duck and Being San Diego are delighted also, because they know we can count on $50,000 a year for the next 15 or 20 years. And that helps budgeting, helps with programs and planning. And yet you have just made a great tax play. And you don't even have to be Jackie Onassis. The Waltons did this, the Walton family did this trust, as well as a local friend of ours, Phil and Penny Knight. So these are powerful tools to use, but at any level, not just at their level. One last one. Ready? You got one more in this? What do you think?
Yeah.
Okay, this is it. The final tip of all. We're in my estate. Maybe my house is even coming to you in my estate. That I really got to watch, my pennies. I'm just not sure, that I can really do more now. And then they pass away, and the house comes to nonprofits. Amazing, it's wonderful. But that donor who had planned to make that gift was paying some taxes every year, some income taxes. And we should all feel sad for them that if they would have only taken one more step, they could have avoided a lot of taxes. And the extra step is if they would have put in their deed that the inheritance of this property, which is what their plan is anyway, the inheritance of this house is being in San Diego. And if they did that, then and so the deed has changed, nothing else. They still live in it. They can paint it purple. They can do whatever they want in the house, legally, hopefully. But because they made that one provision, change their deed, they get a tax deduction mad because they irrevocably committed it. And that deduction is usually crazy. It's based on your age, but it's usually 60 to 80% of the value of the property. So you have a $2 million property, there's over $1 million in a tax deduction unused if you only inherit. So it has those same limitations we talked about earlier. You might only be able to deduct no more than 30% of your income in a given year, and you have only 6 years to use it up. But why not reduce your taxes by 30% per year for 6 years? I mean, you can actually get crafty and give half of it in the retained life estate deed initially, and 6 years later do the other half, and then you get 12 years of tax savings. So there's ways you can really spread it out. But the bottom line is, the most simple concept is you're in my will. It's my house that I am giving to you. The kids don't want it. Frankly, I wouldn't be interested in moving back into my parents' home, inheriting it. And so there's plenty of people who have this provision and they're missing the tax deduction. So the concept of leveraging what are already your plans and to have these great benefits, and that is all she wrote. So that's the retained life estate. We discussed it. We're at the end. It allows you to just talk it through. Know you have the opportunity to leverage your charitable intentions, and you might have a greater impact for yourself and for nonprofits, and you shifted Uncle Sam's cut over to amendment. So there we go. Yes, questions,
What
please.
happens if the nonprofit organization is back?
That's where every deal, hopefully, particularly statute, want to have a gift agreement, something, and you already put in there the default. And you can do it in your deed too. You can say to go to Dean San Diego or Dean San Diego, their list of other nonprofits, and have a separate document that instructs the Attorney General of all those 4 listing of nonprofits who are no longer there, which is very remote. Then you can say, please have this go to the nonprofit that most closely resembles or continues the mission that was being applied by Dean San Diego.
So let's say the nonprofit changes their name or, that could be.
Then you'd show the chain of connection and it would still land with them. But that's an important point for why it's worth planning with Lucky Dr. Dean San Diego when you have your estate, you've done your will, don't keep it to yourself. We're not gonna, if you tell them that you're in their estate, they're not gonna bang down your door and they're not gonna give you Kool-Aid, poison Kool-Aid. They will actually say thank you. You'll join legacy societies, be given inside, access and just rightful appreciation. And you'll be able to have conversations that might allow you to be reminded of some of these planning techniques to better leverage your giving and have the wording so that you have their tax ID number. And then even if the name changes, the tax ID number doesn't. So plan with Dean San Diego or Lucky Duck, and you'll be better off. There we go. That's it.